Hi everyone. In terms of our views on inflation and interest rates, we have broadly two kinds of scenarios. One is the global inflation and interest rate, and other is its impact on the local condition. It is true that over the last 4 to 6 weeks, we have seen the resumption of inflation fears in the global markets, especially in US, and in response to that, we have also seen the spiking up of interest rates. US 10-year is today closer to 1.65%, well above their lows which they were in the last year. Even US inflation, both consumer inflation as well as core inflation, is trending above 1.5%. But having said that, the central bank, US Fed, and the government is in no hurry to withdraw the stimulus which they have embarked upon. And for a time being, it looks like the policymakers will be accommodative if inflation overshoots, till they are very convinced that growth is well entrenched into the system, and we see quarter after quarter of good economic growth and falling unemployment rate. If you juxtapose that scenario into India, we have a slightly different situation. For many years in the run-up to the COVID situation, India had high real rates, that is low inflation, low core inflation, and high nominal rates. However, the COVID changed the situation, and the policymakers responded with a series of cuts and pushed the interest rates low. But parallelly, we saw the revival of inflation. Initially, it started with food inflation, and now we are seeing the inflation spread into some of the core industries. The good side, there is a good side to it and there is a bad side to it. If inflation becomes well entrenched and it keeps trending above the target inflation rate, which is 4% plus or minus 2%, policymakers will get a bit worried. But it's also good in the sense that after many years of extremely low or negative core inflation and manufacturing inflation, we are getting into a positive inflation rate. Positive inflation is good for manufacturers, and it kind of gives them pricing power. It gives them the ability to pass on the cost increases to the end consumers, and in general is good for their profitability. So while in the shorter term it may look as if inflation is trending higher and it may have negative impact on interest rate, we think that the resumption of pricing power gives corporates more earnings power in the coming months, and that sounds good for the earnings. Having said that, we also have to be kept in mind that inflation cannot go too high, and therefore the supply side responses have to be robust enough to ensure that there is no supply constraints in response to the demand which is growing, and that itself should not lead to high prices. And there the situation in India today is a lot different than what it was 5 years back, 5 or 10 years back, when there was a demand increase and supply was not keeping in pace, and that is leading to very high inflation. I think today the supply side mechanisms are a lot more robust, and therefore any demand surge will be probably met better and would cool off inflation. The sum and substance is, we think that inflation in India will continue to remain range bound. Food inflation will moderate, core inflation may inch up, but that should not have dramatic impact on the interest rates and therefore the recovery path in which India is in. I think India will continue to have more quarters of low real rates so that the economy revives better and we see growth again well entrenched in our economy. Clearly, in the short run, market is focused on market response to the liquidity conditions, but it is not driven solely by liquidity either. We have seen that the response of the pandemic from various governments across the world and various central banks have been one of stimulatory in nature, and one with the aim to fix the economic slowdown which the pandemic has created, reverse the direction and ensure that the pandemic doesn't leave very deep scar or deep growth impact on the global economy. So clearly the steps that are taken both in the forms of fiscal stimulus or in the monetary stimulus are measures to ensure that real economy responds to that stimulus. In the short run, it may look like the financial economy is responding to it faster than the real economy, but it is a question of time before you see the real economy also beginning to respond. We are already seeing that, not necessarily specifically to India, but across the world, where the economic activity is improving month after month and quarter after quarter, and unemployment rates are beginning to fall in many of the developed countries. So clearly, it is backed by fundamentals. It's not purely liquidity alone. Liquidity is given initially to weather the storm, but liquidity also has a positive impact on the overall economy, and we are seeing that. It typically comes with the lag. And in India also, we think that the low interest rates and abundant liquidity should have positive impact. For example, Indian banking system versus 2 years back today is awash with liquidity, and not only the balance sheet is liquid, the balance sheet is also well capitalized. Many of the banks used last 1.5 years to shore up their balance sheets, increase their capital adequacy requirements, and be ready for pushing credit to the borrowers over the next few years. The balance sheets of many of these banks, which were in trouble 3-4 years back because of a ballooning of NPAs, the NBFC related issues, etc., have been more or less cleaned up, and many of the provisions which they have made have now started coming down, and year on year we are seeing improvement in their core operating profits as well as less provisions, leading to healthy balance sheet, and this should help the banks to take more courage and lend more into the system. So we are in the beginning of a very good credit cycle, and credit is very important to drive growth, and therefore what the liquidity is leading to fixing the balance sheets of the banks, and fixing of the balance sheets of the banks will lead to better credit growth, and better credit growth will lead to better economic growth over the next few years. One of the problems with Indian economy was a falling contribution of manufacturing sector to the GDP growth rate, and this started 6-7 years back, and we have seen progressively the manufacturing sector's contribution to GVA or GDP has been progressively coming down, and this has its own impact on primary employment and secondary employment, industrial activity, etc. And in the meantime, of course, services sectors were compensating for the growth, consumption and services sector were compensating for the growth. But it's very clear that in the absence of good manufacturing sector growth, employment generation won't be robust, and it has its secondary impact on income, demand, etc. And government seized of this matter, and we saw them come up with series of schemes to revive the growth of the manufacturing sector. It initially started with the PLI schemes for the electronics sector, and now they have rolled out such schemes for various sectors, including defense, textiles, auto ancillaries, autos, etc. And slowly we have started seeing licenses getting issued for companies that want to utilize this production-linked incentive schemes. And we think it will lead to two broad impacts. One is substitution of imports from various countries which are supplying to India, and second is India becoming an export hub for specific goods on the manufacturing sector. And we are in the beginning of that cycle. I think the response from the corporate sector is pretty robust, going by the initial bidding and the outcomes. And we think that over a period of time, the Indian manufacturing sector will slowly begin to get revived, and it will lead to a fresh set of growth opportunities for individual companies, as well as creation of employment and income growth in multiple sectors. As a portfolio, we'll try to look at such opportunities in a holistic manner, not in a sectoral manner. and also from a bottom-up perspective, which companies tend to get benefited out of this. So clearly, in the initial phase, we would see one or two electronics company get benefited directly or indirectly. But over a period of time, we expect it to spread to a pharmaceutical company, a bulk drug manufacturer, an automobile company, etc. And therefore, we think a continuous emergence of opportunity on the manufacturing sector to invest, for investors to invest and make robust returns going forward. One of the conundrums market struggles at this juncture is what is going to be the earnings growth of companies, especially after coming from a pandemic hit year. Very strangely, even in a pandemic hit year, the earnings of companies have not caved. Most companies actually, very surprisingly, despite the challenges on the sales side, have shown remarkable control on costs and have reported till now, till first 9 months, have reported fairly good numbers, and we think that it will keep continuing and build on that particular trend. One of the positive fallouts of the challenging circumstances, most companies cut the unwanted cost, refocused on their core businesses, freed up the cash flows, cash that is stuck in various parts of the business, especially on inventories and receivables, etc., and delivered the balance sheets, improved the capital in their own balance sheet, and kind of become lean and mean going forward. So even in the current year, the top 50 companies are reporting fairly good double-digit earnings growth number. Next year is going to be even better in terms of earnings growth. Fiscal 22, we will have more than 25% kind of an earnings growth for the Nifty 50 companies, and that is going to be very good. More importantly, the earnings are going to be very broad-based. Earlier, between fiscal 16 to fiscal 20, earnings growth used to be very concentrated and in very few sectors. For example, consumer goods companies, retail lending companies, and to some extent IT companies are the only ones which were showing reasonable growth between fiscal 16 and fiscal 20. But now we are seeing the broad basing of earnings in the current year. Banks have joined a robust earnings growth trajectory. We've also seen telecom companies which went through serious earnings degrowth are beginning to show better earnings growth. Commodities, both global as well as local commodities like cement and global commodities like steel, aluminum, all the companies in those sectors, because of buoyant prices, have been reporting very good numbers, and they are expected to continue to report fairly good numbers. Pharmaceutical companies are continuing to report fairly robust earnings numbers. So we think not only the magnitude of earnings growth is going to be robust, but the breadth of the earnings growth is also going to be reasonably robust, so that investors need not have to be extremely concentrated in their portfolios. They can pick stocks and across various sectors, and they can be a little more diversified. So without taking excessive risk, they can achieve robust returns. And that's the reason we are pretty optimistic that fiscal 22 will be a good year, and thereafter we would see, because of the macroeconomic conditions driving credit growth and production growth and manufacturing sector reviving, we will see that momentum continue to build up even beyond fiscal 22. On the valuations of the market, there are again two ways to look at it. One is looking back on the basis of past earnings, and other is based on future earnings. Clearly, if you look at basis of past earnings, it does look overvalued. Why it is so is because the earnings have taken a serious hit over the last 3-4 quarters, and that is making the rolling 4-quarter earnings of index earnings low, and that's why any typical index valuations would be upwards of 30 PE at this juncture. But on a forward basis, because of very high robust earnings growth, upwards of 25%, We are seeing the PE of the market dramatically fall and reach their longer period average or closer to long period average pretty fast, 20 or less than 20 within a year or year and a half. And that is good, because if one were to only focus on earnings based valuations, yes, based on past earnings it does look a bit stretched, but on a future earnings potential basis it looks reasonable. It may be slightly mildly above the long period average, but that is not something we get too worried about. Second is, we should not look at the market as a whole. We should look at various sectors and companies within that. Barring isolated pockets of overvaluation, if you keep them aside, I think by and large the rest of the market seem to be reasonably valued from an earnings basis. But if you look at other metrics like price to book or EV by EBITDA or market cap to sales, markets are not significantly extended versus their long period average, and which gives us the confidence that we are not in any kind of a frothy or a bubble zone in terms of valuation. As long as we see a robust economic recovery, the V-shaped recovery continuing, and companies continuing to keep building on their quarterly growth rate. So it's net, I would say, while the last 12 months have been fantastic for equity investors, we were at a higher level, markets fell, and therefore the bounce looks pretty steep. But if you look through it, the 5-year rolling return of market is not excessive for people to get worried on the valuation at this juncture, and therefore I would say that one can continue to remain constructive on the market despite the short period fall in earnings, and therefore the valuation looking slightly extended. As I explained earlier, in a pre-COVID world, growth was coming down, especially in India. The quarterly GDP growth was touching 4% in December 2019 quarter. And more importantly, the growth was becoming narrower and narrower over a period of time. This led to the market getting polarized and winners becoming fewer and fewer. Just for example, between fiscal 16 to fiscal 20, 2 stocks accounted for 50% of the gains of the index within Sensex, and close to 6 or 7 stocks accounted for the entire gains of Nifty, which means 43 stocks together contributed 0% to the movement of Nifty over a period of 4 years. Mid caps were struggling to perform, small caps were also having challenge in terms of earnings. So essentially we saw a very narrow market, polarization of valuation, and funds which are heavily concentrated did well. Most other funds did not do that well. The more diversified funds are, the less likely they were able to perform well. But things changed post-COVID or during COVID times. We think the breadth of the market in terms of earnings are becoming better. The challenges that were impacting specific sectors are slowly going down. Just to give an example, in a pre-COVID scenario, a lot of healthcare companies were having challenges because they had issues with FDA, they had issues with their approvals in US, drug approvals, etc., and the growth was not very great. The earnings were coming down, and now we are seeing that situation reverse totally. Similarly, in a pre-COVID scenario, automobile companies were saddled with high cost inventory. There was a technology change towards lower emission vehicles. There was cost increases which they were not able to pass on to the end consumers, and this led to fall in profits. And now we are seeing slowly the market absorbing those cost increases, demand slowly coming back, and many of the companies are beginning to report better growth numbers. Like that, we can, sector after sector, if you look at it, we have seen from a bottom-up perspective, fixing of the problems, getting out of that low growth phase, and improving their profitability over a period of last 3-4 years. So there is no need for portfolio managers to be extremely aggressive and concentrated in their portfolio, and one can pick stocks from multiple sectors today than they were earlier, and that is, I think, the single biggest change we have seen. The second thing is on the way stocks were valued. when markets were very narrow, people were willing to pay any valuation for growth. Today, when growth becomes a little more broad-based, the excess valuation in one sector is coming down and extremely low valuation in another sector is getting improved. So, there is some sort of convergence that is happening in valuations. So, it is also a good time for people who are able to find poorly valued growth ideas or undervalued growth ideas and benefit from not only the growth coming back, but also some bit of a re-rating happening on that sectors. Earlier, fund managers are forced to buy only the stocks that are exhibiting growth irrespective of valuations. And I think that situation has dramatically changed, and that is good for especially contrarian fund managers, value conscious fund managers, etc. So, I think these are some of the changes that has happened over the last 1.5 years, and all it points out also is that the winners have rotated a bit. There has been some bit of price and time correction for some of the overvalued sectors, and some bit of revival of undervalued companies and stocks over the last 1 year. One of the things our funds in Franklin Templeton have done is remain diversified throughout the last 5-6 years. We never aggressively concentrated our portfolios towards fewer ideas, which impacted our performance between fiscal 16 and to fiscal 19. For about 2-3 years, we had this challenge. When market breadth became narrow, we kind of lost out on some of the performance. But the flip side is we started buying more and more of the undervalued cyclical growth stocks, which were having growth challenges during that cyclical down phase, but they were becoming cheaper and cheaper over a period of time. So, for temporarily we were looking, and many of the funds were looking underperforming, but portfolios were relatively looking cheaper and better valued versus some of the other growth oriented portfolios. And that remaining diversified, betting on cyclical growth stocks, focusing on valuations you pay for the stocks that you are owning, all the three helped many of our funds to recover their performance in the last 1 year. So much so that more than 50% of our relative underperformance in the previous years are now erased, and we still have some more way to go to erase the entire relative performance better. But we are remaining confident that if the economic revival story remains intact, portfolios are positioned towards that growth coming back in the economy, and many of the growth cyclicals delivering numbers. We also think that our funds continue to remain relatively less expensive versus a pure high growth portfolios or high quality, so-called quality portfolios. The reason is that many of these companies are not only beginning to grow better, they are also moving up the quality curve. They are cleaning up their balance sheets, they are getting out of unwanted businesses, they are improving their capital allocation decisions. All this also lead to a quality upgrade that is available, and we are very open-minded and constructive about playing this growth, not only the growth trajectory going up, but the quality trajectory going up for many Indian companies. I think in some substance, many portfolios are poised for playing the cyclical growth that is coming on our way, and also poised for playing the improved quality of these businesses over a period of time. In closing, it is very easy for investors to look at the last 1 year return of the funds or the stock market and start becoming extremely cautious or negative on the market per se. It's probably very normal. But if you look at slightly longer time horizon, it's not as if equity markets have given phenomenally superlative return over the last 5 years. And if you keep that perspective, then one can relate to what has happened over the last 1 year better. That is point one. Second is, most of our decisions regarding investing in equities not necessarily with a rear view mirror, but with looking ahead what is going to happen. When we look ahead, we do look at fairly a good period of economic growth followed by earnings recovery cycle, and that sounds fairly interesting for investors. Third point why investors should continue to remain constructive on equities is India is going through some kind of a massive change in our corporate landscape. Newer businesses are getting listed. More exciting disruptions are happening on the digital world. Over the next 5 years, we will see many of these Indian unicorns getting listed, and funds are a very good way of playing that, participating in these exciting businesses that are getting listed. Not only the new companies that are getting listed, the existing companies which are changing themselves to play in this rapidly changing economic environment. It provides for an exciting investment opportunities. Some of these winners can provide fairly good growth for investors, and one should not lose track of that longer period objective going forward, and should not therefore base the decisions mostly on last 12 months returns. So I would like to kind of reiterate the point that while it is okay to take some money off the table, but it is also very important to look slightly ahead and look at the exciting investment opportunities which a growing and a developing economy like India will keep throwing over a period of time, and not miss out on those opportunities just to maximize the very short term kind of a goal. So I would therefore urge the investors to remain focused on that, keep their asset allocation goals in mind, and not under allocate the equities at this juncture, irrespective of the mild overvaluation or the sharp uptick that we have seen over the last 12 months.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.